You know times are tough when you look at stocks under $20. I'm just kidding. Doesn't really matter. Under 20, under 100, over 100 doesn't really tell you much about this stock, if it's cheap or expensive. Yes, dollar amount, it's cheap, but valuation-wise, it doesn't really change much, right? A stock at $20 can be way more expensive than a stock at $100, $200, even $500. So in this video, let's touch on 4 stocks under $20. I own a couple of those. I even added an extra because, well, luckily today it is above $20, and that's Intel. The other stocks we're going to talk about will pop up on the screen. And of course, could have added way more. I can add here new holdings, for example, as well. But I thought these ones here should do the trick. If this is enough for you, do leave me a like and a comment in the comment section below. Would really appreciate that. And of course, if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Check out all the other links. There are some good promotions out there as well. Would really appreciate it. And so stock number 1, yes, encore et toujours. Yes, we are speaking here various languages on the channel. Welcome to Duolingo investing channel. SoFi stock. So SoFi is back under $12. It has a market cap of $13 billion. If we look at the drawdown, well, it is down 36% in the last year. Well, that's the biggest drawdown that we've had right now. If you look at the last 3 years, we've had multiple drawdowns of 50%, 40% plus. So this is nothing new for me. Of course, you might say, oh, but look at this performance. It's disastrous. Well, disastrous, I don't know. I mean, if you look at the year on year, stock is still up 50+%. So yeah, could still be a broken stock. Definitely not a broken company. Right now, the average analyst price target sits a little bit above 15% the price we're at today. Of course, the business continues to do what it should be doing. Yes, a lot of focus is still on the tech platform, although the other 2 segments are growing quite quickly and quicker than before. Financial services side is actually growing very, very fast. And under that segment, if you don't know, that's the loan platform business, sits under that segment. And yes, you've probably heard the big news. So they signed their largest loan business platform agreement to date, and up to $5 billion agreement with Blue Owl Capital Managed Fund. This commitment helps them serve the financial needs of more SoFi members. This is great for the business. This is, again, lower risk, high margin business, fee-based business. Then looking at contribution profit, we can see that last year was the first time that financial services, well, had positive contribution profit, and I expect that number to continue to grow. Lending side did also reaccelerate towards the later half of last year. So yeah, all in all, it's true. Bad stock, still a very good company. And when you're still up over 50% since last year, I think you shouldn't really complain that much. And when in doubt, always look at the data. I mean, since Q4 2019, total revenues have increased at a compound annual growth rate of 62.4%. Gross profit margin above 80% now for, well, the last couple of quarters. This company becomes more and more profitable. This company is now profitable for 5 consecutive quarters. So yeah, it will take time. I know a lot of people will say, oh, S&P 500 inclusion, they'll need a market cap of at least, I'd say it's a minimum of $18 billion. You have to stay above that for a while. So I don't think it's going to happen in 2025. To be honest, couldn't care less. It will happen eventually. Moving on to company number 2, and that's Grab. Not only is Grab not just under $20, no, it's even under $10 and under $5. Imagine that. But it has a market cap of $17.15 billion. Remember, Grab got a lot of attention, grabbed a lot of attention a couple of weeks back. Then it reported earnings, stock went down a little bit, but okay, I mean, year to date stock is down now 10%. Year on year stock is still up 31.7%. If you want to learn the whole Grab story thesis, I already made a couple of videos on that on the channel. And at the time of making this video, the average analyst price target sits 36% higher than the price we're at today. If we look at the expected growth for this company, so revenue still expected to grow quite respectively for the next coming fiscal years. Looking at free cash flow for fiscal 25, it's expected to drop 33.8%. But then, as you can see, the next 2 fiscal years growing 39 and 32.6% respectively. Looking at the business itself since the March quarter of 2023, financial services segment the smallest one here, but the fastest growing, grew at a compound annual growth rate of 50.7%. Mobility revenue grew 23.7% CAGR and deliveries 20.3%. Looking at adjusted EBITDA, so how profitable are these? Well, you can say whatever you want about adjusted EBITDA, but this is basically what we got. We have here mobility, the largest part, then deliveries and financial services still here negative. Extra things here, we've got total monthly transacting users last quarter that has reached 43.9 million. That was up 16.4% year over year. So it's a couple of quarters where it's been flat to down-ish, but the number keeps getting bigger and bigger. Of course, if you compare, let's say the 17.2%, that was a June quarter, that was 17.2% year-over-year growth on top of just 7.1% same quarter a year ago. The 16.4 that we're getting right now is already a bit better than, well, the last ones, which was 12.2%, 7.5%. So if they continue like this, I think the trend will just continue up and to the right. Then some other things. Total revenue, of course, has increased quite nicely throughout the years. Free cash flow. We've also seen free cash flow previously was quite negative, and now we are, well, much more in the positive territory. Gross profit margin has also nicely increased throughout the last couple of quarters. As you know, I do not own Grab. I have exposure to Grab through Uber because Uber has a stake in the company. I think it's around right now 12.5% or something like that. Moving on to company number 3, and that's Rocket Lab. Rocket Lab currently trades at $17.57, has a market cap of $8.36 billion. So as you can see here, right, a stock that's worth less than $5 has a higher market cap than a stock that is close to $17, $18 or so. You always have to look at the business, the company, not just what they're trading at. The price that they're trading at that doesn't really tell you much. So Rocket Lab has actually been performing quite well, right? Year on year, stock is up 310%. Year to date, it is now down 29.5%. It did run up quite aggressively in the last couple of months, just like plenty of other stocks. So yes, a pullback back under $20. I did add more to my position, I think a week or so ago. So Rocket Lab, what do? They provide launch services and space systems solutions for space and defense industries. Of course, they want to be that one-stop space shop. Currently, the average analyst price target sits 33.6% higher than the price we're at right now. Looking at the expected growth rates, well, they are expected to grow quite rapidly, more than double their revenue up until 2027, and free cash flow is expected to turn positive in fiscal 26 and then grow by 39.3% in fiscal 2027. Of course, these numbers will probably change depending on a successful or unsuccessful Neutron launch, which should happen in the second half of this year. Once you unlock Neutron, I think this thing goes to the moon. Yes, pun intended. Now, over the last couple of years, of course, we've seen a revenue increase. What we've also seen is that gross profit margin has increased as well. Free cash flow is trending higher. As we've seen, it will take another year or so for it to flip into positive territory, according to the current expectations. Now, I know a lot of people still think that, oh, this is a launch company. No, as you can see, launch services make up a small part of the overall revenue. The biggest part still today is space systems. And in the future will be services, applications, and stuff like that. Looking at where they generate the majority of their revenue, of course, United States, then Canada, and then rest of the world and Japan. And then looking at gross profit, here as well, comes at no surprise. Space systems, the largest chunk, and then launch services has actually improved quite a lot, right? As you launch more and more frequently, margin-wise, it makes more sense. And it will make even more sense when you can launch Neutron and, well, just like with SpaceX, reusable rockets, pretty good business. Now, more recently, we had a couple of announcements with Rocket Lab as well, but I don't want to make this video too long. They're going to acquire another company. I think they're raising money, $500 million worth or something like that. There was also something else. So exciting times, exciting times. I mean, this week, plenty of announcements for Palantir as well. So quite a lot of news. What we're seeing here is the backlog. Now, all in all, backlog did increase year on year, but not by much, right? The backlog for space systems is decreasing quarter after quarter. Backlog for launch services did increase, but I think we're still missing one contract that's not included in that backlog, if I'm not mistaken. Now, like I said, Neutron, very important. Second half of this year, we're going to get, well, we're going to know whether or not they're launching and whether it will be successful. So we'll see what happens. That will definitely be a catalyst, a pretty big one. Moving on to stock number 4, and that's DLocal. DLocal trades at $8.23, has a market cap of just $2.43 billion. Year on year, the stock is down 53%. Year to date, the stock is down 29.2% after being up 20%. The big drop happened, of course, after the latest earnings report. I did a specific video on that as well. Now, currently, the average analyst price target sits 44% higher than the price we're at today. Yes, even after the latest earnings report. If you look at the expected growth rates for this company, this is a company that is still expected to grow quite rapidly. Fiscal 25, 28.3% year-over-year growth, followed by over 23% year-over-year growth for the upcoming 2 fiscal years. And this is also a profitable company, by the way. Now, the problem more recently is, of course, that we've seen margins get hit. Right? We've seen margins get hit, we've seen take rate get hit, and that has basically dragged the stock down. We also know that this happens because management is investing quite a lot in the company in order to position that company, well, much better for the future. I honestly didn't think that it would take that much time. I thought it would have been much shorter, just like with Adyen, for example, a year and a half or so ago. But okay, it is taking a little bit longer. But the overall business, in my opinion, is still doing quite well. We've also seen the last couple of quarters that gross profit did recover and continues to recover, so that's fine. Yes, free cash flow last quarter did take a hit. I think it was there was a one-time thing that happened there. But all in all, this is a company, a business that is growing quite rapidly, net income, so yeah, profitable. And if you look at full year 2025 for guidance, TPV growth, 35 to 45% growth year over year. Revenue between 25 and 35%. Gross profit. I mean, this is still a business that is growing very, very fast, much faster than a lot of other business. It's small, but it's already profitable. So yeah, this one will stay on my list. It's in my portfolio, of course, and now I'm back down. I was up, now I'm back in the red. But this is a business that, in my opinion, the market is just misunderstanding. They did also say that they rather see TPV continue to grow a lot while taking a hit, let's say, when it comes to take rate. They take a hit when it comes to take rate, but they'll make it up in a volume. And I think that's what we're going to see. Plus, some FX headwinds as well. Strong dollar and now weakening dollar could help a company like DLocal, will definitely help a company like New Holdings as well. And then I wanted to talk about Intel, but Intel is now at $23.70 after being up 14.6% on Thursday because of the announcement of the new CEO. So year to date, the stock is actually up 17.6%, believe it or not. But I'm not going to talk about Intel again. I did a specific video about the new Intel CEO yesterday or 2 days ago, depending on when you're watching this video. So to not waste your time, I highly suggest you go watch that. I'm still very bullish on Intel. There are still some question marks, of course. I think a lot of focus is still on 18A, whether that will be on time and really be a game changer for the company. Plus, what happens with the foundry side? Is it going to be split off, sold off, joint venture with TSM, with the others? We'll see. But now that we actually have a CEO, I think we're going to get way more answers than questions in the next quarter and a half. So overall, these are the stocks. Do share your opinion down in the comment section below. Like, subscribe, all of that, and I'll see you all in the next one. Bye-bye.